Watch, it's just going to sit here and spin, I'll bet you. It's been buggy lately, guys. So I think what I'm going to do is just try and get fancy and just see how smart my retention is or how good my retention is. I mean, I'll pop back and look. Sorry, everybody.
So while we're doing this, while Caeli's doing this, again, there's been some questions on talking about, Nancy asked a question about the loan to value, what the minimum property values are. Just as a reminder for anybody not paying attention to the chat, the minimum loan amount for this program is $100,000. Your loan to value or your minimum property value to make that $100,000 does depend on your occupancy and some other factors that you really should check in with your dedicated lending specialist or Caeli Ridge over at Ridge Lending Group. And you can always call call a team at 855-74-RIDGE, or you can email to info@ridgelendinggroup.com. And if you do want to talk about your simulator, Caeli's going to show you exactly where to grab that code so everybody can go over the same data at the same time.
Thank you, Larry Bailey. I just had my lunch delivered. Ooh, that looks good. My husband. Okay, you guys can see my screen. These are the results. Okay, and I just pulled numbers right out of thin air. All right, we can tweak these. We can up and down, east and west, whatever. Play around with it. But let's look at this. This is probably where I think most of you are going to benefit from most in looking at this with me, so that you can kind of get that interpretation, that decoder ring thing. Left side is the all-in-one. The right side is our 30-year fixed. And remember, we were comparing to a 3.5%. on $200,000 was the outstanding balance. So left to right, okay, here's our 200,000. This is saying that in 5.6 years, if all of these numbers are accurate and they're static every single month, okay, which they won't be, things are going to change. It's going to be a little less this month, a little more next month, whatever. But the simulator assumes that this is exactly what it would look like every single month. And in 5.6 years, that $200,000 would be zero. It would be paid to zero, okay? Total interest accrual over that period of time is $55,000 and some change. Total interest on our 30-year is $116, 67 months. You've got $342 left because we had 18 months into this one. Then we've got our total expenses. This plus this equals this, and this plus this equals this. And the difference between these two total expense numbers is obviously this $61,000 right here. Okay, pretty simple. Now let's dig into this. Okay, this is where it starts to get a little bit more complicated. I'm going to go into a little bit more explanation. So let's start with rates and assumptions. All right, every adjustable rate mortgage has two primary components. You have an index and a margin. Okay, the addition of those two numbers equals a fully indexed rate. In this case, the margin, well, let me back up. The margin within those two numbers is fixed. For 30 years, that margin could never, ever change. The margin in this case is 4%. So for 30 years, no matter what happens, that number stays static. Will never, ever move. The variable part of an adjustable rate mortgage is the index. There are dozens and dozens of indices out there. The one that is tied to the all-in-one is the 1-year CMT. That is the US Treasury. Currently, it is posting at 4.710. The fully indexed rate in that case is the addition of those two numbers. 4.71 plus 4% is 8.710. Okay, that is a fully indexed rate, and that is the interest rate that the balance every day will accrue on today, 8.71. A couple other numbers here, a floor rate and a cap or max rate. This number means that no matter what happens with this variable index, up, down, east, west, whatever, the amount of interest that you'll pay daily will never be less than 4.75. So as an example, let's say that the index went down to 0.25, which it's done. It's gone negative numbers before after the 08-09 crash. Well, let's say that the index goes down to 0.25. 0.25 plus 4% would be 4.25, right? Can't have that. The minimum is 4.75. The flip to that coin is the maximum, which is equal to 6% over the initial fully indexed rate. So if you were closing this loan today, you'd be closing at 8.71 on this scenario. Plus 6% would be 14.71. If this number was 8 today and you were closing, this would be 14. Okay, it's 6% over whatever the initial fully indexed rate is. Now, something else, this is important, and I encourage you guys to play around with this. I'm going to change this. So the rate trend says that we are remaining at the initial rate. That's impossible. Remember I said before that we're going to try and keep it as conservative as possible, make the all-in-one look as bad as possible. This is one of the ways in which you would do that. So this assumes that we will not move from 8.71. Do rates just stay on an adjustable rate mortgage? Do you start at one rate and it just never changes? No, right? It always changes. It goes up, it goes down, right? There's always going to be some variable movement within an adjustable rate mortgage. Keeping it at its initial rate is going to be very, very conservative. So what I want to do for us is I want to go back and look at the historical average rate. What the simulator is going to do here is it's going to go back 25 years, okay, 25-year look back, and it's going to add up this index every single month for 25 years, and it's going to divide by that number of months, okay? So what this represents, this is the average rate used, the fully indexed rate. So what does that mean? I wonder if anybody could figure this out. The actual 25-year average of this 1-year CMT is the difference between this and this. So 3.088 is the 25-year average, okay? Right now it's posting at 4.710, but the 25-year average is 3.088, okay? You guys put your questions in there if you have them. Okay, I'll come back to it. You've got some fun things here. Historical rates here. You can look at our 30-year fixed. You look at the Fed fund rate in the purple. There's our 30-year. There's the Fed fund in the orange. There's our 1-year CMT. You'll notice that the CMT and the Fed fund kind of move in tandem. They kind of mirror each other. They're kind of sister indices. Anyway, if you're interested in that. Okay, so everybody clear on this? Let's go back here and let's go here. This is going to be important. So do you see what happened? So guys, when I made this change to the historical rate average, look what happened. I'm saving a little bit more in interest. This went down a little bit, not by huge leaps and bounds, but there's an increase in savings and reduction in amount of time it will take. Okay, so I'm going to skip past the first few lines here, the payments. These are kind of static. I really want to focus on the percentages because I think this is where the explanation makes most sense. So the first thing here, left side all-in-one, here's our 30-year fixed. So average principal reduced annually, 19%. If I take $200,000 times 19%, that's how much I'm paying down my average annual principal reduction versus 3.5% on a 30-year fixed. That's how much you're paying principal on a 30-year fixed amortized mortgage, right? Everybody has ever looked at an amortization table knows that especially in the first 10 years of that 30-year fixed mortgage, how much is going to principal? This much? Very, very, very little, right? So 3.5 versus 19% in the reduction of principal. Next is interest as a percentage of principal, 21.3. If I take $200,000 times 21.3, that's going to equal $42,531. If I take $200,000 times 58.2, that's going to equal $116,333. All right. Now the next numbers are the most important here. So the first one here, the effective APR, comparison loan effective APR. This number means that in order for our 30-year fixed counterpart to compete, in order for the 30-year to amass the same interest as the all-in-one, you would have had to lock your 3.5% interest rate at 1.326. Now, I know rates have been low over the last couple of years, but I don't believe anybody, I do not believe anybody was able to lock in a 1.3% interest rate on an investment property on a 30-year fixed mortgage. I could be wrong, but I'm a betting woman, so I'm going to say no, that's highly unlikely. But that's a telling number, right? Now, finally, this is the most important number on the page. That's the flip to that coin. This says that in order for the all-in-one to amass the same interest as our 30-year fixed, you are going to have to average an interest rate of 13.818. Okay, this one is important because if you recall, we have our historical average here, but we also have a cap rate here of 14.7. Now, I'm going to say something, but I want you guys to take it critically. Okay, I want you to think about this. The absolute best case scenario, and I don't want you to put this in your mind that unless you reach this number that it's not for you, because that is not what I'm saying. But when I see this number exceed this number, for that individual, assuming that their input is accurate, it becomes an absolute foregone conclusion, an absolute no-brainer. Let me show you what I mean. Let's say in my example, I'm going to say that I saved 25%. So I've got $3,750 left over what I'm doing is I want to manipulate. Okay, so by increasing that to 25% monthly of what I'm retaining, my break-even average, the amount of interest on average that I'm going to have to see on the all-in-one to match the same interest as our 30-year fix needs to be 16.48. Why is that so important? My life cap, just as an example, is 14.7. I'll never, ever, ever get to 16 because I'm capped here. You guys with me? Hopefully you guys are following. Okay, so that's just kind of a rundown of what you're looking at on the results. I want to just do a couple other things really quickly. So now what I want to do is, now let's go back here. So let me tell you how I got there. So we're in the results, we're in the pay down summary, this view pay down table, okay? If you scroll through, left side's all in one, right side's our 30-year fixed. If you scroll through here via months, you can see how the balance goes down and what you have access to. Remember, as that drives down, and this is where I get really excited about the all-in-one. The interest savings is great, don't get me wrong. And for some people, it's amazingly great. But for me, the thing that I think that is so impactful for real estate investors and having access to this line of credit for 30 years, not 10 years interest only drop period that then cuts off and then becomes principal and interest with no access for the last 20. That's not what this is. You have access for a full 30 years. But what's so amazing to me is that now you can grab at this and pull more money out on month 15. I have $38,000 that I can go get at on month 18 or month 15 that I can go buy another investment property, right? So let's check this out. Let's just use month 15. There's 38,000 in here. Let me go back and show you what I was going to do with that. My one-time, future one-time expenses. So I'm going to say 30,000. I'm going to pull 30,000 out on month 15, okay? If you do this, very, very important. If you're going to pull the money out and you're going to tell the simulator when you're going to pull it out, you must remember to put the income associated with that property in the deposits page. Don't pull the money out unless it's for something else. If it's for real estate or some other investment that's going to yield a monthly return, make sure you get the deposit in there. For our purposes, I'm going to go repeating deposit, and I'm going to say that 30,000, I'm going to gross $12,000 a month. Okay, excuse me, $1,200 a month. $1,200 a month is my gross monthly. Okay, now this went up by, I don't remember how much. It was probably about $250. Now maybe it's more like $300. So make sure that you're adjusting for that. I could go back and do it, but I just really want to illustrate a point, you guys. It'll be 25% of whatever 1,200 is. I can't do mental math.
$3,000, Caeli, on the last run.
Yeah, but I upped this from 20 to 25%, so that has already changed. Yep. So it's probably, 25%. Whoever wants to do the mental math, go ahead and do it for me. That's what this was added to of the 1,200 in gross rents. That's what's being left over, because I'm not using my net proceeds from that rental property for living expenses right now. I'm going to let it ride, and I'm going to let it ride in here, and I'm going to save myself some interest. Okay, so as such, you can see how the numbers change, and you can continue to do this over and over and over again. So why don't I take a breath, Larry, and open up for Q&A? I'm sure there's questions.
We've had some questions, and I've
real quick. Sorry. So if you guys are in here, you want to mess around, here's where you're going to save, right here. There's your key code that you're going to put in back on that first get started page. Okay, I'm ready.
It's really important that key code is actually how if you want to do a direct consultation afterwards, that's the key code they should provide, right, Caeli?
That would be great. I mean, you don't have to. If you guys just want to do it with me, that's fine. But if you have that, yeah, send that to me so we can start there, and then we'll go through the tabs and make sure that the input is correct, and then we can go and look at your results together.
Do you mind sharing that code on screen one more time? We've got some folks, I think if you save it there, right? So
take a picture of it if you want, guys.
Yeah, I'll put it in the chat.
Okay.
Hang on 1 second for me, Caeli. I'm going to type as fast as I can do it.
You want me to read it to you?
No, we're good. So that code, anybody on the call or even afterwards, we'll leave this up. You can go ahead and play around with this, but keep in mind, it's a shared code. So Tom, if you make a change, James, you're going to see that. So it's not going to go right when everybody tries to modify the information. So if you are using this code on today's call or a replay, please don't modify the information because you're going to ruin it for somebody else. We'll see how
Yeah.
long that lasts for.
Okay. And if you guys wanted to, everything that we just went into, you can download a PDF of this and it'll all be on, condensed if you like looking at the stuff that way better.
Love it, love it, love it.
Yeah.
We do have one really important question. I think
Okay.
Katie nails the question, Caeli, that we see a lot. And so I'm going to read the question. So in the all-in-one, are you not paying multiples of what you pay on a regular mortgage monthly? Meaning, do you also calculate opportunity cost over other investments you could make with the extra money that you pay into the all-in-one? So this question's come up a couple times in chat today. One question was from Tom, and he's like, well, listen, instead of just like leaving the $3,000 in the all-in-one account, what if you took that $3,000 and paid down on a traditional mortgage? Wouldn't you still save the same amount? And I think that's the recurring theme in some of the questions, Caeli, is like, why is leaving the money in the all-in-one a better play from your experience versus doing something else with the money each month?
Well, doing what? So if we're talking about taking this $4,000 and sending it off and prepaying on this $200,000 mortgage with your 30-year fixed, yes, you could do that. You're going to accelerate the payoff that much faster, right? And you'll pay a lot less interest, of course, but you're tying up that capital. You cannot get that back. You cannot go back in and say, I want to use this for this investment, or hey, my car blew a gasket and I need to pay for this month or whatever. I don't have access to that money anymore. The only time I'm going to be able to get that, every month if I send that off with my regular mortgage payment, my 30-year fixed mortgage payment, is a full cash out refinance, right? There's probably a bigger rabbit hole we can go on into where that's regarding or where that's concerned, but I would say that my answer is flexibility. If you wanted to, absolutely, 100%. Take that $4,000 and apply it every single month with your 924.95 and right, this whatever that PITI is. Send all that off to your 30-year fixed mortgage, and you will pay a significant amount of less interest, and you'll pay off that much faster. But then what do you have? You have a free and clear property.
And I think you're saying, I want to make sure everybody on the call and on the recording who sees this later really understands what, Caeli, you said in the past, which is, okay, great, but what are you doing with that money today? And so the question that Katie asked, and I think others have asked in the past, is, listen, does it make sense that you're going to have this extra $3,000? Like, let's say you found an opportunity and you're going to have to carry that property for a few months where it's going to cost you $2,500 to rehab it and get it ready for new tenants. Maybe then you don't have the extra money left over at that point, but you'll still have the opportunity to manage your money accordingly and not be locked into a 30-year fixed traditional loan. Is that fair? Yes,
absolutely. Yeah, it's at your discretion and your choice. Remember, the simulator assumes it's being left in there. It does not have to be. It's exactly the same as a checking and savings account that you have today. Now, if let's just say that you've got $4,000 that you can go put somewhere else and make a return of 10%. Remember, you guys, it's interest saved versus interest earned. So if you can take that $4,000 and earn 10% over here versus saving 8% over here, probably put it in the 10%, right? So it's really going to depend on what the return of the investment is and what we're talking about. But more often than not, what you can see how this is going to work, and you can see every single month, right? You can kind of, assuming this is static. Remember, these numbers, this simulator assumes that this doesn't change every month. It's exactly the same for 4.7 years. How realistic is that? It's not. So the flexibility, you got to be looking at what the investment over here is, what is it going to yield versus what are you getting here, and you'll make those decisions. Remember, the math won't lie.
Terrific. So at this point, we've concluded the review of the results. If anybody has any questions, obviously ask them. If you want to take the dive and let Caeli go through some hypothetical numbers for you, whether they're real or not, we will never know. But if you want to go ahead and either raise your hand on the platform and I can take you off mute, or send me a note or plug in what variables you want Caeli to put on screen, and we can speak to them. Katie asked another question, and so did Tom. So we'll get to two questions here, Caeli. Number one, what is the minimum you have to pay in the all-in-one mortgage each month? If the minimum on the all-in-one allows you to pay the same for each product, what's the difference? So I guess let's just take it easy. What is the minimum payment each month?
So I was hoping that somebody was I was waiting for someone to ask this question. This is where I got stuck initially too. And bear with me, okay? There is no minimum payment. Okay, and why I can say that is that let me give you an example. This is not how you would use the product, but I think that this illustrates the point. So if you have a line limit of 200,000 and you have a balance of 100,000, there is zero deposit required. That is not how you want to use it. That's not true. Some people would use it that way for their own purposes. I'm not going to get into all of that, but you could. So no payment, no deposit whatsoever would be required in that case. The only time a deposit is required is when the balance is about to exceed the limit. That's the only time a mandated deposit would be required, and that would be the amount of interest that was going to accrue for that month based on that balance every day for 30 days. Okay, so what is the payment? There's really no payment due. Your depository incomes are being used as the payment. Does that make sense, Tom or Katie? Was there a second part to your question or anything that came up as a result of that answer?
So, yep. So Katie, just added, if there is no minimum, how would you figure out the payoff timing forecast? So if we did want to satisfy at any particular time, how does that work versus obviously a traditional mortgage, which has the interest predetermined?
It tells you here. So what you're going to need, the math is going to be too complicated for me to give you an example because it's variable and it's based on the specific numbers that you may have. And Katie, if you want to unmute yourself and we can have a dialogue, but it's going to depend on.
Yep, you've gone ahead and might have a chance to unmute yourself.
Hi, Katie,
if you want.
Hi, sorry.
Hi.
Hi. Thank you for this. I'm still trying to wrap my head around it, but it's definitely clearer than the last time I was trying to. Thank you. I guess my question is since there's no minimum, if you were to make the same payment on both products, so the same, I don't remember how much you're paying on the mortgage, but whatever that value is, if you were to use that, what is it, 924 plus the 481? Is that what it is?
Well, that's what it's assuming it's being
15.
left in there. Yeah. So what there?
Okay. So if you're effectively paying, if you choose to pay, if you were to pay the same on the traditional mortgage and the all-in-one, how would the numbers change? I guess that's ultimately.
I see what the question is, Caeli. So the reality is, so what the question is, Caeli, for you to answer is, if you were to pay the same amount, meaning that you were to pay $924 on the 30-year fixed and you were to pay $924 on the all-in-one, what would that look like?
Yeah. So if we take out this, so, and I thought I mentioned that up front, maybe I didn't, you guys. This loan is not going to be for somebody that has zero money left over at the end of the month or that has 50 bucks. This residual income is what will drive the all-in-one and greatly reduce that principal balance and greatly reduce that interest and pay off sooner. So watch what happens. When I leave that as zero, it's going to, well, just watch. You save zero, you pay off later based on the rate assumptions and things that we have in here, okay? So it will not work. So the individual who this does not work for is the individual that has nothing left at the end of the month. Generally speaking, depending on the numbers that we're comparing to, or let's say you're comparing to a new loan based on all those variables, generally speaking, we find that as long as the individual is saving 10% a month of their monthly depository, it's typically, the all-in-one is typically going to fare better than a 30-year fixed. Katie, does that answer your question?
I'm going to take that as a yes. There's
Okay.
no notes, Caeli, but she's off mute. Her response was noted. Yep.
Okay. Was there another question from Tom about this?
No, I think we've had all the questions answered. Ron just asked if we'd be putting this recording up on the community for replay. So yes, if you're here and you walked in late, totally fine. Thank you for coming. We'll actually be posting this 3-part series up on the community. That way you can drill into the part of the presentation that you wanted to catch up with.
And you guys, there's no dumb question. So really, we've got maybe another minute or two if you want, or longer if you guys need. If you have a question, don't feel shy or embarrassed. Okay, I promise you, I was every bit as much of a
Oh, that's a good
novice when I
question.
started this. Okay, Larry, you ask a question.
Because for me, this kind of answers Nancy's question originally. Loan to value, right?
Mhm.
So what is it? Is it all one big one loan to value? Does it depend on occupancy, on what we can
It
borrow?
does, yeah. So I'll quickly run through qualifications, and then before I forget, if any of you wants to do this one-on-one with your specific scenario, please just get a hold of us, info@Ridgeland & Group. Larry gave you that stuff, and we'll schedule some time, okay? So qualifications, non-owner occupied investment properties, cash out refinance, 70% loan to value is the max, $100,000 minimum initial draw. We can make exceptions to that. So if you're below that, let us know. We'll look at it with you. If it's a purchase or a rate and term refinance, 75% is allowed for a non-owner occupied investment property. $1 million is the maximum line amount on an investment property. 720 is the minimum credit score necessary for an investment property on the all-in-one. Debt to income ratio can go as high as 43%. That is the max. Fannie Freddie lets us go to 50. So this is a little bit more scrutinized in the qualification piece. The reserve requirement is going to be 15% of the line limit. So if you have a limit of $100,000, $15,000 is what we need to see in a reserve, a checking, savings, or retirement account, asset account of some sort. That's if you go all the way to 43% debt to income. If you're at 40% or less debt to income ratio, the reserve goes to 10%. And guys, this is all beautifully written out on a little cheat sheet that we'll put in the community as well. Larry, the FAQ for the all-in-one and the highlight guidelines, we can get that out there. Yep. Owner occupied, 80% loan to value across the board. So cash out refi, rate and term refi purchase is 80%. There's no difference. 700 is the minimum credit score there. 2 million is the maximum line limit on the owner occupied. And the rest of it is applicable as well. The the DTI and reserve is the same, independent of the occupancy.
Did have one question come through, Caeli.
Yeah.
Byron asks, what if your goal is cash flow and to leverage as much as possible? If interest rises, it sounds like you have to calculate how much you need to leave in so you won't have to pay more interest than a traditional product in case you want to purchase more properties down the road and then plan on taking a withdrawal. How would you address that? The cost for concern over interest rate rising.
So I think that if you want to be hyper conservative, you can go, you can go here. And you can go remain at the initial rate. You could even go max rate as calculated based on your variables if you wanted to. And that assumes that it stays like that the entire time, which is not possible, as is remain at the initial rate. That's not possible either. But you can get your answer. Was it Byron, I think? Sorry, Byron, by messing around in here on the rate trend.
Yep, that's great. Question here, Caeli, can you do this loan if you have 10 or more financed properties?
Yes, thank you for that question. You can have as many as 20 financed properties and still qualify for the all-in-one.
Awesome. And Katie, we're going to take one more stab at making sure you're clear. And like Caeli said earlier, Caeli, I think you said it took you, a long time to really wrap your head around this. But the question, the way Katie puts it is, I thought this calculator compares doing an all-in-one versus doing a regular mortgage, but not both. So the question is, in terms of understanding the calculator best, maybe if you helped explain, Caeli, what helped you understand it best in terms of when you're looking at the comparison, like what you're really seeing. Like earlier you talked about comparing the interest expenses, and maybe that helps other people understand why this loan might be helpful for them.
So if I'm understanding the question, Katia, this particular scenario that we're looking at here is comparing today's all-in-one with this scenario, 30-year fixed, that somebody has an existing loan. The other thing that you can do with this is compare it to a new loan, right? Where you know that either it's a purchase, right? You're buying another property and you know what the terms of that new mortgage is going to be. You can compare it to the all-in-one. Or let's say that you're going to do a cash out refinance one way or another. So you're going to either do it as a 30-year fixed or you're going to do it as an all-in-one. Then you would select in this dropdown a new loan. In our case, we are comparing to the loan that you have now, exactly the terms that this example has put forward. So this results page says, this is what your 30-year fix looks like. This is a foregone conclusion. You know that this is what it's going to be if what I put here is accurate. That's what your 30-year fix is going to do. This is what your all-in-one will do based on these other variables that we dumped in here. Is that what you're asking, Katia?
Yep. Oh, I'm sorry. There's Dolly. Sorry. Katie, if you have any more questions, seriously, like, anytime you want to call over Original Lending Group,
Please.
talk you through exactly what's happening to make sure you understand it, and don't feel frustrated if you're not getting it now or even the first few times. Caeli and I have both been in banking for quite a long time, and this is not something you see every day. So it does take time to understand it. And
True.
I'll also say it's for real. It really is. I would have one on my house right now if I could have gotten a higher loan to value. So that's why I brought up the loan to values, Caeli.
Yeah. And guys, just do the simulator. If you have the input right, it will tell you if this is not the loan for you. It'll be very, very clear in this page. You're going to look here, you're going to look here, and you're going to look here within these numbers. It'll be very clear whether or not you are a good candidate for this loan today.
Perfect. So for those that are left here, Caeli, first of all, thank you very much. If I could speak to the community, your insight and information is always, always welcome. So thank you for doing this. And anybody else, we're going to have this recording up shortly on the community. If you want to go back and replay it in the meeting chat, if you scroll through that, you'll see the code for the scenario the simulator that Caeli used. It's also there on screen, that 5MT. And last but not least, we do these calls every Tuesday live at 4:30 p.m. Eastern with all new topics. Thanks for coming. Caeli, you rock as always. Any last words?
Thanks, Larry. I would just say, let's remember to get the FAQ and the highlights, the underwriting guideline highlight out for everyone in the community too, so you guys will have access to that. There's some good information.
Sounds like a plan.
Okay, guys.